Is your investment portfolio aligned with the spirit of the times? Today, we are living in the era of economic security. With geopolitical risks at an all-time high, we must focus on the economies and industries that directly impact national security, evaluate their investment appeal, and adapt our strategies accordingly. Nations around the globe are pouring capital into their future strategic industries. Artificial intelligence, robotics, energy, defense, quantum computing, and the advanced manufacturing that connects them all. Today, we introduce the ultimate ETF investments to capture these massive shifts. If you are short on time, please use the timestamps below to navigate straight to the ETFs you need.
The world is rearming, and investors who positioned themselves in defense 5 years ago have seen returns most people only dream about. But here's the real question. Are you holding the right defense ETF? Today, we're breaking down the two heavyweights, ITA and SHLD. And by the end of this video, you'll know exactly which one belongs in your portfolio. Let's set the stage first. In 2025, global military spending crossed $2.8 trillion. A 2.5% increase year over year, and that number is still accelerating. NATO members, shaken by the Russia-Ukraine war, are now targeting 5% of GDP on defense spending. Countries that spent decades underfunding their militaries are now in full rearmament mode, buying everything from tanks to drones to cyber defense systems. Now, a lot of these countries want to build their own weapons, sovereign defense capability, domestically made jets, homegrown missile systems. And on the surface, that sounds like bad news for US defense contractors. Wrong. Here's why. Modern weapons aren't like cars you can just build in a new factory. The engines, advanced radar systems, avionics, the critical components are heavily monopolized. And who holds most of those monopolies? US defense giants. Look at South Korea's KF-21 fighter jet, a major domestic defense project. South Korea still had to bring in Indonesia as a partner just to make the economics work. Because the R&D costs are astronomical, and without scale, the per-unit cost becomes unbearable. The global race to build domestic weapons is, paradoxically, a massive tailwind for US defense contractors. They supply the irreplaceable core components that no one else can match. At least not yet. So how do you invest in this megatrend? Let's compare the two leading defense ETFs head-to-head. ITA, the iShares, US Aerospace and Defense ETF, has been around since 2006. It's the original, around $15.8 billion in assets, with deep daily trading volume. Liquid, established, reliable. Top holdings: GE Aerospace, RTX, Boeing, Lockheed Martin, Northrop Grumman, the titans of American defense. But here's the issue. ITA is 100% US focused, and it carries significant exposure to commercial aviation. Boeing, as you probably know, has had a complicated few years. That's dead weight in a pure defense play. Now let's look at SHLD, the Global X-Defense Tech ETF, which launched in September 2023. It's newer, smaller, around 7.4 billion in AUM, but the performance speaks for itself. Over the past year, ITA returned 61.68%, phenomenal by any measure. SHLD, 77.92%. That's not a rounding error. That is a structural advantage. So what's SHLD doing differently? SHLD is roughly 50% US and 50% global allies, Europe, South Korea, and other NATO-aligned nations. Its holdings include Lockheed Martin and RTX, yes, but also Rheinmetall from Germany, one of the biggest beneficiaries of European rearmament, Hanwha Aerospace from South Korea, and Palantir, the AI and data analytics company now deeply embedded in modern military operations. This is not your grandfather's defense ETF. This is a fund built for 21st century warfare. Here's my core thesis. The nature of war is changing. The next major conflict won't be decided solely by who has the most tanks. It will be decided by AI superiority, cyber capabilities, electronic warfare, and drone technology. ITA gives you the legacy industrial base. Still important, still very lucrative. But it misses the global rearmament story happening right now in Europe and Asia. SHLD captures all three pillars of the modern defense supercycle. First, the traditional US defense industrial base. Second, the European rearmament boom. Third, the AI-driven future of warfare. That is a more complete portfolio for where the world is actually headed. Now let me be balanced. ITA's size and liquidity are real advantages for large investors, and all defense stocks are sensitive to government budget cycles. Any political shift toward reduced military spending creates headwinds. SHLD carries currency exposure from its non-US holdings, and as a newer, smaller fund, it has slightly less track record to lean on. These are manageable risks given the macro backdrop, but always do your own due diligence. Let's bring it home. The defense supercycle is not over. If anything, we may still be in the early innings. Between ITA and SHLD, my preference is clear. SHLD captures the fuller picture of where defense spending is going, globally diversified, tech-forward, and built for the trajectory of modern warfare. ITA is not a bad fund, but if you want to position for the next 5 years, not just the last 5 years, SHLD deserves a serious look.
Space is highly profitable. Or more accurately, space is no longer just a realm for romantic scientific achievements. Today, it has become the ultimate theatre for economic security and the battleground for global capital hegemony. Consider SpaceX. By mastering reusable rocket technology, they shattered the cost barrier to space. Building on that, their Starlink satellite network proved its critical value in the Russia-Ukraine war, dominating the battle space even when terrestrial communications were completely destroyed. This proved to the world that space technology isn't just a commercial service, it is a core asset for national security. Welcome back to the Kairos, your source for global macroeconomic analysis. Currently, the US government is leading the Artemis program with over a dozen partner nations, establishing a massive beachhead for human exploration of Mars. But the real smart money in the capital markets is focused on something else entirely: orbital data centers. Recently, SpaceX, in collaboration with xAI, initiated a project to build AI data centers in space. The goal? To solve the terrestrial constraints of limited space, massive power consumption, and critical thermal issues by utilizing the infinite void, abundant solar energy, and near absolute zero temperatures of orbit. And their big tech rival, Amazon, isn't sitting on the sidelines. They recently acquired Globalstar for $11.6 billion, securing a low Earth orbit satellite network and exploring their own space data center initiatives. The front lines of capital have officially moved to orbit. However, as investors, we need a cold dose of reality. The space industry is, by nature, a cash-burning machine. Dr. Jin-Han Kim, the developer behind South Korea's Nuri rocket engine, captured it perfectly. Space is a privilege, a sacred territory granted only to nations that can tolerate failure. It requires astronomical budgets, immense time, and the endurance to survive continuous setbacks before reaching profitability. So why is the entire world investing so aggressively? Because for nations today, investing in space is no longer just about fostering science. It is an absolute survival strategy for national defense and the new growth engine for AI dominance. In modern warfare, if you lose orbital control, every weapon on the ground loses its eyes and ears. This brings us to the Kairos' actionable investment strategy. In today's macroeconomic storm of higher for longer interest rates, investing solely in cash burning, pure play space companies can be extremely risky. To survive and thrive, your portfolio must blend the explosive growth of the space economy with the massive cash flows and military security capabilities of traditional defense contractors. Rather than picking single stocks, ETFs are the optimal vehicle. Depending on your risk profile, consider these three distinct ETF strategies. First, the ARKX ETF. Led by Cathie Wood, this ETF perfectly illustrates our space meets defense thesis, capturing aerospace innovation backed by the solid fundamentals of defense titans. Second, the UFO ETF. This is your standard, broad market choice if you want to capture the entire value chain of the space industry, from satellites to communications. Finally, the NASA ETF. For those seeking aggressive growth, this ETF provides a unique exposure to explosive, privately held space companies like SpaceX. Space is no longer just the stars in the night sky. It is the most fiercely contested frontier of economic security. Analyze the holdings of these ETFs carefully and build a portfolio that offers both defensive stability and explosive future growth. If the geopolitics of the 20th century was a bloody history written over oil, the 21st century is being reshaped by a silent war to secure rare earth elements, the ultimate requirement for AI dominance. Today, major global powers are engaging in an all-out invisible war to secure rare earths and fortify their supply chains. We are experiencing a massive transition from the age of oil to the age of electricity. EVs, power-hungry AI data centers, solar arrays, and wind turbines all require critical minerals. Even the world's most advanced stealth fighter, the F-35, relies heavily on them. From the broader economy to military defense, rare earths and critical minerals have become the absolute backbone of global economic security. Amidst the fierce technological and hegemonic competition between the US and China to secure these resources, how should investors prepare? In this video, we present three strategic ETFs. The first is the REMX ETF. REMX is the most recognized and largest by assets under management among rare earth and strategic metals ETFs. Tracking a global index, it holds a high weighting in Chinese mining companies, accurately reflecting the current reality of China's monopoly in the rare earth supply chain. Investing in major rare earth and strategic metal mining companies like Albemarle in the US and Pilbara in Australia, REMX is a passive strategy highly concentrated in pure play companies. It is ideal for investors looking for broad market tracking exposure to the current dominant players. The second is the SETM ETF. Focused on the energy transition, SETM targets uranium, lithium, copper, nickel, and rare earths. It goes beyond just rare earths, encompassing minerals essential for green infrastructure and defense, offering broad exposure to critical minerals as a whole. Crucially, SETM is heavily weighted in Canada, Australia, and the US. It represents a direct bet on the friend-shoring of the Western world. It is the ultimate beneficiary of the Canada Strong Fund we discussed in our previous video, directly aligning with Canada's aggressive economic growth and resource strategy. The third is the EART. While similar to REMX, EART focuses specifically on critical minerals vital for disruptive future technologies. If REMX is a traditional pure-play mining ETF, EART casts a wider net, capturing the essential minerals required for innovations like EVs, robotics, and aerospace. In the context of the ongoing US-China hegemonic rivalry, if you want to bet specifically on the minerals powering new technologies like AI and EVs, EART might be the more suitable choice. However, investors must keep one thing in mind. Historically, commodity prices exhibit extreme volatility, making rare earth investments relatively high risk. Therefore, to strictly manage your investment risk, we strongly advise maintaining a conservative position size within your portfolio.
Nuclear weapons shaped the balance of power in the 20th century. Today, a new technology threatens to rewrite the entire global order. It's not a weapon you can see or hold, But it could render every military advantage, every financial network, and every encrypted secret obsolete in an instant. That technology is the quantum computer. Right now, the United States and China are locked in an existential race. Billions of dollars, thousands of scientists, national security itself on the line. The question isn't whether quantum computers will change the world. The question is, who will build one first? Most people think a quantum computer is just a faster calculator. They're wrong. A quantum computer is the absolute weapon. The one tool capable of instantly shattering every encryption system that protects our financial networks, our military secrets, and our personal data. Every major bank, every government agency, every smartphone. All of it runs on encryption that assumes only traditional computers exist. If China perfects a quantum computer before America, they could theoretically decrypt decades of American military communications and financial transactions. If America gets there first, China's entire digital infrastructure could be compromised overnight. This isn't theoretical. This is the existential stakes of the quantum race. This is what experts call quantum supremacy. But national security is only half the story. The artificial intelligence revolution is hitting a massive wall. The AI systems we use today, ChatGPT, Claude, Gemini, they're powerful, but they're approaching the limits of what traditional computers can achieve. To unlock true artificial general intelligence, or AGI, we need computational power that doesn't yet exist. Here's the key difference. Imagine you're trying to escape a maze. A traditional computer is like a person walking through the maze, one path at a time, checking dead ends one by one until they find the exit. It's methodical, but slow. A quantum computer is different. Using a principle called superposition, where quantum bits, or qubits, exist as both 0 and 1 simultaneously, a quantum computer explores thousands of paths at once, instantaneously. It finds the exit while the traditional computer is still checking the first corridor. Protein structure analysis for drug discovery, problems that would take a supercomputer 10,000 years to solve. A quantum computer could finish in minutes. This isn't incremental improvement. This is a paradigm shift, and it's the only key to unlocking the next stage of artificial intelligence. So, where is the money flowing? Where is the smart capital positioning itself? Just a few years ago, the quantum computing market was dominated by pure-play startups. Companies like IonQ and Rigetti. They were innovative, they were exciting, but they were also high-risk, burning through enormous amounts of capital while chasing a dream that might never materialize. That's because quantum computers face brutal physical constraints. They require temperatures colder than outer space to operate. The slightest vibration, the smallest electromagnetic interference, and they fail. Perfecting this technology requires capital on a scale that only the largest technology companies can afford. And that's exactly what's happening now. IBM is dominating the quantum hardware ecosystem, rolling out processors with hundreds of qubits. Microsoft and Google have launched Quantum as a Service, renting quantum computing power to enterprises through their cloud networks. This isn't speculative anymore. These companies are already generating revenue. Meanwhile, NVIDIA, which doesn't even build quantum computers, is creating an entire ecosystem that simulates quantum circuits using its GPUs. NVIDIA is selling the pickaxes in the quantum gold rush. Here's what makes quantum computing so complex. Right now, we don't know which technology will win. Superconducting qubits, ion traps, photonics, topological qubits. Each approach has passionate advocates and significant backing. No clear winner has emerged yet. In this wide-open race, concentrating all your capital in a single company like IonQ is closer to gambling than investing. You're betting that one approach beats all the others. You're betting on a single horse in a field of many. That's why sophisticated investors take a different approach. Instead of picking winners, they buy the entire ecosystem. They invest in every company that benefits from quantum computing's development. regardless of which specific technology ultimately prevails. This is where the QTUM ETF, the Defiance Quantum ETF, comes in. The ETF's greatest strength is its near-equal weight portfolio strategy. By holding mega-cap tech giants like Microsoft, Nvidia, and IBM, the fund provides stability and reliable cash flow. Simultaneously, by equally weighting smaller quantum innovators, it captures the explosive upside potential, the chance for 10-bagger returns that early-stage tech companies can deliver. It's a balanced approach. You're not over-concentrating on any single technology or company. The fund uses regular rebalancing to track the quantum computing, machine learning, and cloud computing ecosystems as they evolve. This is how institutional investors position themselves in transformative technologies. We have to be honest about the challenges. Quantum computers still struggle with error rates. A quantum computer can explore thousands of paths simultaneously, but those calculations are fragile. Environmental interference causes errors. Correcting those errors requires redundancy that current systems can't reliably achieve. There's also a real possibility of a quantum winter, a period where progress slows, hype fades, and capital dries up. It happened in AI. It could happen in quantum computing. And make no mistake, this is a high beta sector. The volatility rivals commodities markets. This is not an investment for the faint of heart. But history teaches us something important. Throughout economic history, when great empires stake their national survival on a sector, when governments pour astronomical subsidies into research and development, the industry doesn't simply fail. It evolves. Growth may fluctuate, timelines may shift, but the fundamental trajectory continues forward. The United States and China are now treating quantum computing exactly this way. Both nations recognize that whoever achieves quantum supremacy first will control global security, financial systems, and artificial intelligence for decades to come. That level of commitment doesn't disappear because of technical setbacks. We are witnessing the final physical innovation that will reshape our world. This is the ultimate endgame of technological hegemony. And the quantum computing ecosystem, the companies building the hardware, developing the software, and creating the infrastructure, represents one of the great investment opportunities of our generation. The question isn't whether quantum computers will matter, they will. The question is, will you position yourself to benefit when they do? It's time to secure your position in this transformative technology, not with your entire portfolio, but with a meaningful allocation to the quantum computing ecosystem. The moment artificial intelligence steps into a physical body, when it moves beyond screens and software into the material world, everything changes. That moment is now. From factory floors to your home, from manufacturing plants to hospitals, robots equipped with AI are about to infiltrate every aspect of our lives. And if you're going to make an investment decision in this space, the time to do it is before that transformation accelerates beyond recognition. This is the Kairos. We deliver the sharpest macroeconomic insights available. Today, we're dissecting the BOTZ ETF, your gateway to the robotics revolution and the era of physical AI. For the past 2 decades, artificial intelligence has been trapped inside a box, a monitor, a data center, the software world. But that era is ending. AI is now gaining a physical body, and that body is the robot. For the first time in history, the lines between artificial intelligence and robotics are dissolving. The two are merging into a single, inseparable entity. This is what we call physical AI. The implications are staggering. Software AI can analyze data and make recommendations, but physical AI can actually act. It can move, it can build, it can work, it can reshape the material world in real time. And the smart money knows this. The institutional capital that built fortunes in software AI is now pivoting hard toward robotics and physical AI. The game has fundamentally changed. Here's the macroeconomic crisis driving this pivot: labor. Over the past 5 years, developed nations have been reshoring manufacturing. The United States, Europe, Japan, they're all bringing factories back home. This is a rational response to global supply chain fragility and geopolitical tension. But here's the problem: there's no one to work in these factories. Developed nations are facing a demographic cliff. Birth rates have collapsed. Immigration can't fill the gap. Younger generations don't want factory jobs. The result is severe, structural labor shortages that threaten the entire economic model of the developed world. This is not a temporary problem that will fix itself. This is an existential threat to prosperity. The only solution is automation. Not robots as a luxury, robots as a necessity. Robots don't take vacations, they don't strike, they don't demand benefits. They maintain consistent 24-hour productivity. This is why robotics innovation has shifted from being a nice-to-have technology to being a national survival imperative. Countries that crack the robotics code will thrive. Countries that don't will decline. Did you watch the Consumer Electronics Show, CES, in Las Vegas this year? It was the signal. The clearest possible signal that robotics is now at the center of the global innovation race. For decades, CES was about cars and smartphones, flashy consumer devices that generated buzz and headlines. This year, robots owned the stage. Tesla didn't showcase another vehicle variant. Elon Musk showcased Optimus, a humanoid robot designed to perform general labor. Hyundai didn't talk about engine innovations. They announced a $1 billion commitment to Boston Dynamics, the leading robotics company in the world, to integrate advanced robotics into their ecosystem. Hyundai, Amazon, BMW, Samsung, every major technology company on Earth brought robots to CES, not as a side attraction, as their centerpiece. This wasn't marketing theater, this was declaration of intent. The world's largest companies are all in on robotics. So, how do you invest in this transformation? The answer is the BOTZ ETF, managed by Global X. This is not a single company bet on Tesla or Boston Dynamics. This is exposure to the entire global physical AI ecosystem. Look at how BOTZ is geographically weighted. It tells you everything about the philosophy behind it. United States, the homeland of AI software, the brain. Japan, the world's best at precision machinery. Robotics manufacturing, sensors, control systems. Japan is the unmatched leader here. China, massive manufacturing infrastructure, scale. Switzerland, advanced precision engineering, high-tech manufacturing. South Korea, advanced robotics innovation and semiconductor manufacturing. United Kingdom, emerging AI and robotics research. This geographic diversification is deliberate. It reflects reality. No single country has all the pieces needed for physical AI dominance. You need American AI software, Japanese precision engineering, Chinese manufacturing scale, and European technical expertise. BOTZ gives you all of it. Now look at the top holdings. This is where the real insight lies. A robot needs 3 essential things. First, an AI brain, the computational core that makes decisions. That's NVIDIA. NVIDIA designs the chips that will power every advanced robot on Earth. Second, sensors and vision. The robot needs to see and understand the world. That's companies like Japan's KDEF, which dominates industrial visual sensors globally. Third, precise control systems. The joints, the arms, the actuators that turn intention into movement. That's Switzerland's ABB and Japan's FANUC, the global leaders in industrial robotics and motion control. But BOTZ doesn't stop there. It also includes promising mid-cap and small-cap companies like South Korea's Rainbow Robotics, the next generation of innovation leaders. This is a complete ecosystem. You're not betting on one technology or one company. You're holding the entire value chain of physical AI. You own the brains, the eyes, the hands, and the future innovators who will integrate them all together. Here's why this moment matters so profoundly. We're at an inflection point. For the past decade, AI has been a software story. Impressive, revolutionary, but ultimately confined to digital systems. The money flowed to companies building algorithms and language models. But the next decade will be about physical AI. Robots that operate in the real world, in our factories, in our homes, in our hospitals. The money is now moving toward companies that manufacture these systems, provide the components, and build the enabling technologies. The shift has already begun, but it's still early. The robotics market is nascent compared to what's coming. NVIDIA has already experienced a tenfold increase in valuation on AI demand, but robotics adoption is just starting. When robots begin operating at scale across manufacturing, logistics, healthcare, and consumer applications, the capital requirements will dwarf even the AI boom we've seen. That's where the secular growth opportunity lies. Not in mature software companies, but in the entire robotics ecosystem, from component suppliers to systems integrators to the foundational technology companies. Right now, just before the massive brain of artificial intelligence puts on the steel body of a robot to dominate our world, you face a choice. Will your portfolio reflect this new reality? Or will it remain trapped in the past, betting on technologies that are already priced for perfection? BOTZ offers a straightforward answer. Diversified global exposure to the robotics and physical AI ecosystem at a moment when adoption is accelerating, but valuations haven't fully captured the scale of the opportunity ahead. This is not speculation. This is positioning yourself in the most fundamental economic transformation of our lifetime. We're witnessing the birth of physical AI. The robots are coming. The question is not whether, but when. And once they arrive, the companies that enabled that arrival will have reshaped the global economy. Invest accordingly. South Korean equities are capturing the attention of the entire world. In 2025, the KOSPI surged by 75%, and the KOSDAQ climbed 37%, recording the highest returns among all major global stock markets. And the momentum hasn't stopped. As of May 11th, 2026, the KOSPI has posted an unprecedented year-to-date return of 80%. What is the secret behind this explosive rally in South Korean stocks? It comes down to two industries reshaping the global economy: AI semiconductors and the defense sector. South Korea stands at the absolute center of both as a manufacturing powerhouse. In today's video, we will analyze the macroeconomic environment driving the Korean market and present an actionable way to invest through the US-listed EWY ETF. First, South Korea is riding a massive AI supercycle. Big tech doesn't just exist on US exchanges. The South Korean market houses the critical semiconductor giants that make big tech possible. To seamlessly run AI tools like ChatGPT or Gemini, massive AI data centers are required. And those data centers run on HBM, high-bandwidth memory chips. Today, the only companies in the world capable of mass-producing HBM at scale are South Korea's Samsung Electronics and SK Hynix. The numbers speak for themselves. From the beginning of 2026 to May, Samsung's stock has soared over 130%, while SK Hynix has skyrocketed by more than 180%. As long as global AI infrastructure investment continues, the profit margins of these two giants are expected to be sustained, or even climb higher. Second, South Korea is rapidly expanding its defense exports, backed by unrivaled manufacturing competitiveness. Before February 2022, many NATO members enjoyed a peace dividend, slashing defense budgets for decades. The invasion ended that overnight. European nations suddenly needed to rearm, and fast. The critical question was, who could deliver artillery, armored vehicles, and advanced military systems at an industrial scale, at competitive prices, and strictly on schedule? The answer, repeatedly, has been South Korea. The Korean defense industry has secured multi-billion-dollar contracts with nations like Poland, Romania, and Norway. K2 tanks, K9 self-propelled howitzers, and FA-50 light combat aircraft are now staple equipment for European militaries. South Korea is no longer just a regional buyer, it has become a premier global defense exporter. Simultaneously, the global energy transition has triggered a shipbuilding boom dominated by South Korea. LNG carriers, highly complex vessels transporting liquefied natural gas across oceans, require a level of engineering precision achieved by only a handful of companies globally. HD Hyundai, Hanwha Ocean, and Samsung Heavy Industries are sweeping the majority of global LNG carrier orders. This is geopolitics translating directly into revenue. And unlike the semiconductor cycle, the defense and shipbuilding cycles are driven by long-term government procurement programs, meaning they tend to flow in 10-year supercycles rather than single-year spikes. Third, the brand value of South Korean corporations is at an all-time high. Companies like Samsung Electronics, Hyundai, Kia, and LG have transitioned from being fast followers to global premium brands deeply familiar to consumers. This continuous elevation in brand value translates directly into higher margins and consequently higher stock prices. Fourth, we are witnessing the death of the Korea discount. In July 2025, South Korea passed a landmark amendment to its Commercial Act, legally mandating that corporate directors act in the interest of all shareholders, not just the controlling families or chaebols. Treasury stocks, once hoarded to maintain family control, must now be cancelled. The influence of controlling families has been further restricted by a 3% voting rights limit when appointing audit committee members. The result? The structural discount that plagued Korean equities for decades is finally lifting, and foreign capital is flooding back into the market. Finally, South Korea has achieved remarkable political stability. The nation swiftly and democratically overcame the illegal martial law crisis of the previous administration. Under President Lee Jae-myung, South Korea has restored institutional trust in its liberal democracy. By resolving political uncertainty through a peaceful transition of power, it provided immense relief to global capital markets. Today, South Korea's CDS premiums are at their lowest levels, signifying a drastic reduction in geopolitical country risk. So, how can you actually invest in everything we've just discussed? For most foreign investors, especially those in North America, the simplest answer is a single ETF, EWY, the iShares MSCI South Korea ETF issued by BlackRock. What makes EWY so compelling and simultaneously concentrated is its holding structure. The top two holdings are SK Hynix at approximately 25% and Samsung Electronics at 24%. Combined, they make up nearly half of the entire fund. Buying EWY is essentially placing a massive bet on the AI memory semiconductor thesis, bundled with broader exposure to the Korean market including Hyundai, Hanwha Aerospace, Doosan Enerbility, and Korean financials. For investors who want even more concentrated semiconductor exposure, a new ETF launched in April 2026, ticker DRAM, holds Samsung, SK Hynix, and Micron in roughly equal weights. Think of EWY as the full Korean buffet. DRAM is a concentrated single bet on memory. Even with this explosive growth, the EWY ETF remains deeply undervalued compared to the QQQ or SPY when looking at key metrics like the price to earnings, P/E, and price to book, P/B ratios. But what are the risks you need to know? First, concentration risk. With nearly half the fund in two stocks, any slowdown in HBM demand or missteps in Samsung's foundry business will directly hit the ETF. Second, currency risk. EWY holds won-denominated assets, meaning the USD to KRW exchange rate will impact your returns. The Korean won can be volatile. Third, geopolitical risk. North Korea remains a constant risk premium priced into South Korean assets. Fourth, valuation risk. After a 120% rally over the past year, you are no longer buying at the absolute bottom. Corporate earnings must now catch up to these valuations. Here is my view. EWY is the single most efficient ticker to simultaneously express three major theses: the AI infrastructure cycle, Korean corporate governance reform, and global defense expansion. The Korea discount is ending. AI semiconductors, defense exports, global brand prestige, governance reform, and political stability. These five structural forces are converging simultaneously for the first time in South Korean stock market history. EWWI is the simplest vehicle to access this historic inflection point. But, as always, invest with conviction and size your positions accordingly. Look at the global markets right now. Everyone is fixated on the AI boom. When foreign investors look at South Korea, the crowd is hyper-focused on generic tech ETFs like EWY and the semiconductor cycle. But while the masses are staring at silicon chips, the smart money is quietly accumulating something much heavier: defense. Welcome back to the Kairos, where we decode the flows of the global macroeconomy. Today we are talking about a paradigm shift into what Ray Dalio calls a war economy. In this new world order, the true backbone sustaining the South Korean economy is the defense industry. By the end of this video, you will understand exactly why South Korea has become the arsenal of democracy, dominating land, sea, and air. And most importantly, we will reveal exactly why the KDEF ETF offers an overwhelmingly high investment appeal right now, easily rivaling traditional US defense ETFs like ITA or SHLD. To understand the K-defense boom, we must first look at the vulnerabilities of the Western world. The reality is that the West's arsenals and manufacturing capabilities have hit rock bottom. After undergoing de-industrialization for the past 30 years, NATO realized that their production lines were completely frozen the moment a massive land war broke out. It literally takes years for massive Western defense contractors to deliver new artillery. But this crisis isn't just limited to the land. Currently, the US Navy is facing the worst bottleneck in its history. America's aging shipyards are struggling to even maintain their existing fleets, let alone build new warships fast enough to counter the rising threats in the Pacific. But in the midst of this geopolitical panic, there was one nation perfectly prepared: South Korea. Because South Korea never shut down its defense manufacturing lines, it has become the global gold standard for speed, scale, and reliability in the ground weapons market. The K9 Thunder, which now commands half of the global self-propelled howitzer market, and the K2 Black Panther tank sweeping across Europe are the ultimate proof. But it doesn't stop there. The FA-50 light combat aircraft is actively being exported to Asia, South America, and Europe. And the Cheonggung-2 missile defense system, having proven its performance and secured massive deals in the Middle East, has become the top priority acquisition for major nations worldwide. The next massive supercycle is currently unfolding in the sky and at sea. The KF-21 next-generation fighter jet has successfully completed its development phase and is throwing down the gauntlet in the global export market. Simultaneously, South Korea's overwhelming prowess in shipbuilding is translating directly into naval dominance. Korean-built frigates and offshore patrol vessels have been exported to various nations, including the Philippines and Peru, securing vital maritime choke points. However, the true wealth in the defense industry comes from MRO, maintenance, repair, and overhaul. And right now, history is being written on the ocean. Due to the severe shortage of US shipbuilding capacity, the US Navy has officially begun outsourcing the MRO of its naval vessels to South Korean shipyards. The greatest naval force in history is now relying on South Korean infrastructure to maintain its combat readiness. This is an unprecedented structural shift. On top of this, let's talk about Canada. The Royal Canadian Navy is currently accelerating the Canadian Patrol Submarine Project, CPSP, to acquire up to 12 new submarines to protect its massive coastlines and the Arctic. South Korean maritime titans are currently the absolute frontrunners. They are pitching the KSS-3 class submarines, which feature advanced air-independent propulsion, AIP, for extended underwater endurance. But the real reason Korea is winning: they are the only ones who can actually deliver these 3,000-ton submarines on Ottawa's urgent timeline. Furthermore, the South Korean government is drawing the blueprint for the introduction of nuclear-powered submarines. This technological leap will permanently cement South Korea as a global naval defense superpower. Now, let's ask the most important question. If the entire world is rearming, shouldn't you just buy traditional US defense ETFs like ITA or SHLD, which hold great companies like Lockheed Martin and General Dynamics? The reason the smart money is pivoting to KDEF is clear. It all comes down to the difference in execution and valuation. When you buy ITA or SHLD, you're buying into companies trapped in a fundamental bottleneck. Yes, they have massive order backlogs, but they suffer from extreme labor shortages and broken supply chains. They lack the physical capacity to quickly convert orders into revenue. Ultimately, investors are forced to pay a high premium, a high PE ratio, to giant corporations that take 5 to 10 years to actually deliver the weapons. In stark contrast, KDEF's core competitive edge is speed to market. Because South Korea possesses active, immediately operational production lines, the estimated $78 billion order backlog amassed by K-defense firms translates directly into explosive earnings growth today, not in the distant future. Korean companies are seamlessly absorbing the market vacuum in Europe and the Middle East, created by the slow pace of US defense contractors. Therefore, KDEF offers significantly higher growth velocity, crystal clear earnings visibility, and a much more attractive valuation compared to the heavy traditional US defense ETFs. So, how can you capture this macro trend in your portfolio? The Plus KDEF ETF is a pure-play defense ETF that tracks the core powerhouse companies of the defense industry. With this single ticker, you can instantly invest in the giants of defense. You capture Hanwha Aerospace and Hyundai Rotem dominating the land wars, and Lignex's one leading missile defense. At the same time, you gain exposure to the maritime titans, Hanwha Ocean and HD Hyundai Heavy Industries, the very companies winning US Navy MRO contracts and building the next generation of warships and submarines. KDEF is not just a simple Korean ETF. It is a direct solution to the manufacturing crisis in the Western world and the ultimate geopolitical hedging index. In this new world order, nations must arm themselves, and South Korea stands as the supreme weapons supplier encompassing land, sea, and air. While the masses bet everything on consumer tech stocks, make sure your portfolio is equipped with the strongest shield. In the modern global economy, the United States stands as the ultimate apex predator. It commands the intellectual architecture of artificial intelligence, holds an absolute monopoly over global software ecosystems, and wields the US dollar as an unparalleled weapon of financial hegemony. Yet, beneath this glittering canopy of digital supremacy lies a massive structural vulnerability. Silicon Valley can design the most advanced algorithms in human history, but it cannot physically build the infrastructure required to sustain them. Over the past 4 decades, the material foundation of the Western world, heavy manufacturing, advanced hardware engineering, precision grid infrastructure, and naval shipbuilding, has been systematically hollowed out. Now, as the geopolitical rivalry between Washington and Beijing transitions from a cold trade dispute into an absolute battle for supply chain survival, America faces a terrifying realization. It has lost the physical puzzle pieces required to anchor its global dominance. For years, global capital markets ignored this physical deficit, assuming that open markets and offshore manufacturing would indefinitely supply cheap goods. But that illusion has shattered. the South China Sea has transformed from a commercial highway into a volatile geopolitical fault line. The West can no longer outsource its critical hardware to nations that may pose a direct threat to its long-term security. The global supply chain is fracturing along ideological lines. This is not a temporary disruption. It is a permanent rewiring of global macroeconomics. The United States desperately needs a manufacturing core alliance, a group of highly advanced, ideologically aligned partners capable of producing high-end hardware at an unmatchable scale. And to understand where the smart money is moving to capture this monumental shift, we must look at an unprecedented financial migration unfolding across the Pacific. Welcome back to the Kairos, where we decode the flow of global macroeconomics and track the smart money. Recently, the Financial Times highlighted a jaw-dropping phenomenon taking place in the South Korean capital markets. Driven by an insatiable global demand for artificial intelligence hardware, the Korean Kospi Index experienced an extraordinary 18-month surge, multiplying its value and outpacing the historical trajectory of the late 1990s Nasdaq.com boom by nearly 6 months. This historic rally was not fueled by speculative retail mania, but by massive, calculated inflows of global institutional capital. Tech titans like Samsung Electronics and SK Hynix saw their valuations skyrocket by over 130% and 170% respectively, effectively carrying the entire index on their shoulders. Wall Street has realized that while America owns the software of the future, South Korea owns the physical factories capable of printing that future onto silicon. However, this dramatic index explosion exposed a profound paradox within the financial markets: extreme valuation polarity. While global capital concentrated heavily into Korea's technology behemoths, the broader domestic manufacturing base remained deeply, inexplicably discounted. Even amidst this historic AI supercycle, the forward price-to-earnings ratio of the Korean market hovered at an astonishingly low 8.6 times, compared to the rich 21.2 times multiplier of the US S&P 500. This stark divergence represents one of the largest valuation arbitrage opportunities in modern financial history. Recognizing this anomaly, the South Korean government launched its aggressive Corporate Value Up program, a sweeping structural reform designed to eliminate the historical discount and unlock shareholder value across its industrial champions. For sophisticated global investors, the conclusion became obvious. The traditional passive broad market indices are no longer sufficient. To capture the true manufacturing renaissance, capital required a highly targeted vehicle. This brings us to the ultimate strategic investment thesis of this macro cycle. Recently listed on the New York Stock Exchange under the ticker KMCA, the Plus Korea Manufacturing Core Alliance Index ETF represents a paradigm shift in thematic investing. KMCA does not blindly buy the entire Korean market. Instead, it operates as a precise filter, isolating the exact manufacturing core alliance that the Western supply chain desperately requires. It strips away the underperforming legacy sectors and concentrates capital exclusively into the industrial titans dominating the global hardware supercycle. By analyzing the underlying mechanics of KMCA, we uncover the three critical industrial pillars that make this portfolio an indispensable asset for the New World Order. The first foundational pillar of the KMCA portfolio is the advanced AI hardware and semiconductor supply chain. The world is beginning to understand that artificial intelligence software is entirely bottlenecked by physical memory limits. An advanced AI accelerator from NVIDIA is practically useless without high bandwidth memory, or HBM, capable of transferring massive datasets at lightning-fast speeds. KMCA concentrates heavily on SK Hynix and its core equipment suppliers, such as Hanmi Semiconductor. These companies do not merely compete in the global semiconductor landscape. They hold a functional monopoly over the generation of HBM3E and next-generation memory architectures. As large language models expand exponentially, the demand for this specialized hardware is decoupled from traditional consumer electronics cycles. KMCA isolates this high-margin, high-growth core, giving investors direct exposure to the material backbone of the digital age. The second vital pillar within KMCA is the unprecedented synergy between advanced defense manufacturing and naval shipbuilding. As we highlighted in our previous deep dive on Indo-Pacific geopolitics, the United States Navy faces a severe crisis. Its domestic shipyards are paralyzed by massive backlogs and labor shortages, making it impossible to build or repair combat vessels at the pace required to match regional expansion. To resolve this, Washington is leaning heavily on South Korea's maritime industrial complex. Korean shipbuilders maintain an unmatchable global reputation for delivering complex guided missile frigates, corvettes, and commercial vessels ahead of schedule and under budget. Furthermore, Korea's defense giants have become the de facto arsenal of democracy, exporting advanced F-A-50 fighter jets, K-2 tanks, and precision artillery to nations spanning from Eastern Europe to the Philippines. KMCA captures this defense supercycle, turning geopolitical tension into structural portfolio resilience. The third and perhaps most overlooked pillar of the KMCA thesis is the global power infrastructure and nuclear energy boom. The exponential rise of hyperscale AI data centers has triggered an unprecedented surge in global electricity demand. The world is facing an energy trilemma. It requires massive power, absolute reliability, and zero carbon emissions. To build this future, the Western world must completely overhaul its crumbling electrical grids and transition toward next-generation nuclear power, including small modular reactors or SMRs. This infrastructure supercycle requires an immense volume of ultra-high voltage transformers, substations, and reactor components. KMCA holds a dominant concentration in the precise industrial conglomerates, such as HD Hyundai Electric and LS Electric, that are sweeping up multi-billion-dollar grid modernization contracts across North America and Europe. This guarantees that KMCA investors are directly positioned to capture the massive capital expenditure flowing into the global energy transition. When you synthesize these three pillars, you realize that the KMCA ETF represents the intersection of three irresistible macroeconomic forces: friendshoring, valuation arbitrage, and structural industrial growth. Wall Street is recognizing that this is not just a standard thematic index. It is an economic security alliance packaged into a liquid, tradable vehicle. By stripping away legacy sectors and focusing entirely on the core manufacturing champions, KMCA allows global capital to bypass broad market volatility while gaining pure exposure to the physical architecture of the next decade. As the Korean government's Corporate Value Up program continuously forces structural corporate re-ratings, the historic discount at 8.6 times PE is destined to close. The smart money is not waiting for the fog to clear. It is actively rotating into the hard assets that underpin global power. Ultimately, the global economy is transitioning away from the purely digital, borderless illusions of the past 20 years. We have re-entered an era where physical manufacturing capacity, supply chain resilience, and sovereign defense technology dictate the wealth and security of nations. South Korea has established itself as the indispensable manufacturing core of the free world, the missing puzzle piece that the Western alliance cannot survive without. And through the KMCA ETF, global investors now possess the precise tool to deploy capital alongside this grand geopolitical shift. How do you view this massive capital migration into the manufacturing alliance? Is your portfolio prepared for the hard asset renaissance? Share your analysis in the comments below. For the past century, global hegemony was dictated by one single commodity: crude oil. Wars were fought, empires rose and fell, and the entire geopolitical world order was drawn around the pipelines of the Middle East. But today, the macroeconomic chessboard has fundamentally flipped. We have entered the era of the energy transition, and the new currency of global power is no longer black gold. It is white oil, lithium, rare earth elements, and the advanced battery supply chain. Welcome back to the Kairos, where we decode the flow of global macroeconomics and track the smart money. If you analyze the raw data of all the battery materials mined globally, from lithium and graphite to cobalt and nickel, you are not just looking at an eco-friendly trend. You are looking at the foundational physical assets of the next industrial revolution. But, unlike crude oil, which was largely balanced by a Western-aligned global market mechanism, this new critical mineral supply chain is being monopolized by a single superpower in a way the world has never seen before. To understand the sheer scale and velocity of this geopolitical shift, we only need to look at the top tier of electric vehicle manufacturers today. Over the last decade, Western media and retail investors have been entirely fixated on Tesla and Elon Musk. But beyond that fog, a behemoth in the East was quietly and methodically building an empire. Looking at the hardware and supply chain data, China's BYD has not merely caught up to Tesla in sales volume, it has completely rewired the global EV ecosystem. However, China's true terrifying power does not lie in simply assembling and selling cars. Their absolute masterstroke was securing the upstream supply chain long before the market even existed. Decades before the United States or Europe realized the strategic importance of electric vehicles, Beijing was aggressively buying up lithium mines in South America, securing exclusive cobalt rights in Africa, and establishing a near-total monopoly on the chemical refining processes required to turn raw dirt into battery-grade materials. This brings us to the most critical Achilles heel of the Western world. You can mine lithium in Australia or Chile, but before that lithium can be put into an electric vehicle, it almost certainly has to be shipped to mainland China to be refined. This is the ultimate geopolitical choke point. Today, China controls over 60% of global lithium refining, and an astounding 70 to 90% of the processing market's share for other critical battery metals. They've effectively weaponized the supply chain. In our previous videos, we analyzed how the United States is rapidly friend-shoring its semiconductor and defense manufacturing to highly reliable allies like South Korea. But the battery sector presents a massive, paralyzing dilemma for Washington. Even with the passage of the Inflation Reduction Act, injecting billions of dollars in subsidies to rebuild a domestic supply chain, the mathematical reality is cold and undeniable. The West cannot currently decouple or de-risk from China in the battery sector without completely crippling its own automotive industry. The supply chain is simply too deeply entrenched. But right on top of this supply chain battlefield, another massive macroeconomic megatrend is converging, one that will completely rewrite the paradigm of human mobility. That trend is artificial intelligence-driven autonomous driving. Many retail investors view electric vehicles and autonomous driving as two separate technological paths. But from a macroeconomic hardware perspective, they are a single, inseparable ecosystem. We must ask a fundamental question. Why must advanced autonomous driving systems be built exclusively on electric vehicle platforms, rather than traditional internal combustion engines? As autonomous software evolves toward Level 4 and Level 5 fully driverless robotaxis, the vehicle must be equipped with ultra-high-performance AI processors, alongside dozens of high-resolution cameras, LiDARs, and radar sensors. The computational power required to process trillions of bits of topographical data in real time is astronomical. A traditional internal combustion engine, relying on a standard 12-volt battery and an alternator, mathematically cannot sustain this massive continuous electrical load. Only an electric vehicle, equipped with a massive 400-volt to 800-volt high-voltage battery architecture and precise electronic control units, can serve as the physical body capable of keeping that AI software alive. Furthermore, autonomous AI algorithms require microsecond-level precision to control steering and braking. The instantaneous torque and digital responsiveness of an electric motor are vastly superior to the mechanical delays of a combustion engine. Therefore, the conclusion is absolute. As global tech titans expand the autonomous and robotaxi ecosystems, the structural demand for the batteries and lithium required to power these vehicles will multiply exponentially. The evolution of autonomous driving is the exact catalyst that will ignite an unprecedented explosion in the demand for white oil. So, how does smart money deploy capital into a sector that guarantees unstoppable structural growth but is plagued by extreme geopolitical friction? They do not gamble on predicting a political winner. Instead, they buy the entire chessboard. This exact macroeconomic strategy is perfectly encapsulated in a single financial instrument: the Global X Lithium and Battery Tech ETF, trading on the New York Stock Exchange under the ticker LIT. Average retail investors look at the LIT ETF and see a simple green energy or climate change fund. But through the lens of a global macro analyst, LIT is something far more profound. This ETF is a financial mirror reflecting the ultimate geopolitical proxy war for the future of mobility and autonomous infrastructure. When you dissect the internal holdings of the LIT ETF, you realize its sheer strategic brilliance. On one side of the portfolio, you hold the champions of the Western Alliance. You own Albemarle, the world's premier lithium miner fighting to secure American supply lines, alongside Tesla, the absolute pioneer of autonomous driving software and EV architecture. But simultaneously, on the other side of the portfolio, you hold the giants of the East. You are heavily invested in BYD, the very company challenging Tesla's global throne, CATL, the undisputed king of global battery cell manufacturing, and Ganfeng Lithium, the Chinese behemoth aggressively monopolizing global mining assets. This is not a portfolio that avoids geopolitical risk. It is a portfolio that absorbs it. If the United States successfully weaponizes tariffs and subsidies to build a fully localized battery and autonomous network, the Western blue chips in this ETF will lead a massive valuation rally. Conversely, if China's monopoly over raw material refining and cheap manufacturing proves to be an impenetrable fortress, the Chinese heavyweights, which make up a massive portion of the fund, will capture the global market share and drive your returns. The true investment appeal of the LIT ETF lies in its underlying mathematical certainty, regardless of the political crossfire. No matter how fiercely Washington and Beijing battle over trade tariffs, export controls, and supply chain dominance, the direction of human progress is locked in. The global transition away from combustion engines and the relentless march toward AI-driven autonomous robotaxis is an irreversible historical force. The vehicles that will dominate the roads of tomorrow, processing massive amounts of AI data, will undeniably be powered by lithium-refined batteries. Therefore, investing in the LIT ETF means you are not betting your capital on a specific chess piece or trying to time the geopolitical headlines. You are executing a highly sophisticated capital allocation strategy by owning the chessboard itself. In a multipolar world where macroeconomic uncertainty is the only constant, aligning your portfolio with physical hardware realities and guaranteed structural growth is the ultimate hallmark of smart money. As this fierce war for white oil and autonomous supremacy rewrites the global economic order, how is your portfolio positioned? Do you believe the West can break the refining choke point, or is the future of mobility already decided? Share your sharpest analytical insights in the comments below. If you want to pierce through the fog of global macro complexity and stay ahead of the massive capital rotations, make sure to subscribe to the Kairos. Until next time, invest smart, stay vigilant, and be prepared. Thank you.